Welcome back. Now we're going to explore Chapter 3, the income statement. The income statement is the second statement we'll analyze. Last chapter we looked at the balance sheet and the assets, liabilities, and owner's equity. And we were also introduced to the concepts of debits and credits and how we record transactions. The income statement shown here is based on the income statement equation of revenues minus expenses equals net income. Business's main goal is to generate a profit, and this statement is the means to track the profitability of a business. A manager or owner may intuitively sense how the business is doing. They might know that they're doing well based on the number of customers coming in or the fact that customers aren't or they're not buying anything. But a more reliable management approach is to evaluate the revenues and expenses reported on the income statement. Revenues are the amounts a business charges its customers when it provides goods or services. If Sonic Gateway in this example sells 9,000 downloads of its app in September and charges $1 per download, then the sales revenues would total $9,000. Revenue is reported when the company transfers control of a good or service to a customer, regardless of when the company is paid by the customer. Key there, regardless of when the company is paid. The amount of revenue earned during the period is the first thing reported in the body of the income statement. Expenses are costs of operating the business, incurred to generate revenues in the period covered by the income statement. Expenses are reported when the company uses something, like a space in a building or supplies for providing some services or the efforts of employees in terms of wages. Basically, whenever a business uses up its resources to generate revenues during the period, it reports an expense, regardless of when the company pays for the resources. Expenses are reported in the body of the income statement after the revenues. Net income is calculated by subtracting the expenses from the revenues. It is a total. Note, though, that it's not an account like salaries, expense, or sales revenue. It is just a total. And because it is a total, net income summarizes the overall impact of the revenues and the expenses in one single number. It is called a net loss if the expenses are greater than the revenues, and then it's a net income if revenues are greater than expenses. Net income indicates the amount by which the stockholders' equity will increase as a result of the company's profitable operations. For this reason, net income or net loss, here we have a net income, it's positive, of $2,000. It's closely watched. It's a closely watched measure of a company's success. And here's just a reminder about the time period assumption. Often, dividing a company's long life into shorter chunks of time, such as months, quarters, and years, will give the business a better gauge on how well it's doing. Like most people, you probably look at the balance in your bank account, and you gauge that for how your financial performance is. If I was to look at my bank account and see I have a lot of money, I would say I'm doing pretty good. If I looked in there and saw, oh my gosh, I'm going to overdraft, then I'm going to say I am not doing very good. If the overall balance increased this month, you likely take that as a sign that you've done a good job of managing your finances. And if it's gone down, that's a clue that you need to tame your spending next month. Because the cash inflows and the outflows occur close in time to the activities that cause those cash flows, using your bank account tends to give a decent measure of financial performance. Now, this is a cash basis of accounting. Cash basis of accounting records revenues when cash is received and expenses when cash is paid. However, the cash basis of accounting doesn't measure financial performance very well when transactions are conducted using credit rather than cash. Remember our discussion on accounts payable last chapter? We talked about buying something on account, paying somebody later. If you use the cash basis, how would that affect your expenses? The problem is that credit often introduces a significant delay between the time an activity occurs and the time it impacts the bank account balance. A better method of accounting is needed, one that reports the revenues and the related expenses during the same period. So an alternative method of accounting would be to report revenues and expenses when services are actually provided, regardless of when cash is received or paid. This approach is called accrual basis of accounting. It's kind of a funny word, accrual basis of accounting. It produces a better measure of the profits arising from the company's activities. According to GAAP, remember the generally accepted accounting principle, those rules that we live by, the accrual basis is the only acceptable method for external reporting of income. The rule of accrual is that the financial effects of business activities are measured and reported when the activities actually occur, not when the cash related to them is received or paid. Now that is, revenues are recognized when they are earned and expenses when they are incurred. The two basic accounting principles that determine when revenues and expenses are recognized under accrual basis accounting are called the revenue recognition and expense recognition principles. Again, that's the revenue recognition and expense recognition principles. When we recognize those when they actually occur, not when cash is given or received. All companies expect to receive cash in exchange for providing goods and services. Of course, they need their money. But the timing of cash receipts does not dictate when the revenues are recognized. Instead, the key factor in determining when to recognize revenue is whether the company has provided goods or services to customers during the accounting period. There are three possible cases here when the cash can be received in comparison to when the revenue is earned. If you've ever been on an airplane before, chances are you probably went on the airline's website or called a travel agent and you paid for those airline tickets before you actually got on the plane and the service was rendered. In this example here, Sonic Gateway receives cash for gift cards that customers can redeem later when purchasing from its online store. Same thing as kind of the airlines. Cash was received before the service was rendered. Now, Sonic Gateway will record the cash received when it issues the gift card, but since it hasn't been delivered or hasn't delivered any goods or services to the customers, no revenue can actually be recorded. Instead, Sonic Gateway has an obligation to accept the gift card as payment in the future. This obligation is a liability called unearned revenue and is recorded on the balance sheet in the amount of the cash that was received. Unearned revenue is a liability. Revenue will be reported later when the goods or the services are provided in exchange for the gift card. But for the time being, it's not Sonic Gateway's legal right to have that money, so we put it down as a liability. Now in case 2, the cash is received with the sale or the service. This one's easy. Cash sales are common for companies selling to consumers, like going to a restaurant and paying for the service when it's actually incurred. For example, Domino's Pizza collects cash within minutes of delivering the pizza to a customer. Now in Sonic Gateway's case, customers pay for game purchase from the company's online store the same day the items are downloaded, so cash and revenue are reported at the same time. Notice here that revenue increases Now here's the last case of the timing of reporting revenue. In case 3, the cash is received after the sale or service. In this situation typically arises when a company sells on account. Selling on account means the company provides goods or services to a customer not for cash, but instead for the right to collect cash sometime in the future. This right is an asset called accounts receivable. In our Sonic Gateway example, app sales are on account because Apple and Google wait 30 days before releasing customer payments to Sonic Gateway. And thus, when an app is initially purchased for download, Sonic Gateway records sales revenue on the income statement and accounts receivable on the balance sheet. Later, when payment is received, Sonic Gateway will increase its cash account and then decrease its accounts receivable account. No additional revenue is reported when the payment is received, because the revenue was already recorded when the app was downloaded. Let's recap. In the first case, cash is received before the sale or the service. When the cash is received, we have an asset, and our cash goes up. But it's not our money. We haven't done anything for it yet, so we're going to record it as a liability called unearned revenue. Then, when the promise is fulfilled or our service is rendered, our liability will go down, and then we'll switch that amount to actual revenue. In case 2, when cash is received with the sale or service, we can go ahead and record that cash as an asset and record our revenue at the same time. In the last case, the sale or service happens, and then we receive the cash afterwards. So our asset increases in an account called accounts receivable. We'll receive that money later. But we can record the revenue because we actually provided that service. Later, when we actually get the cash, we'll move the asset down out of accounts receivable and the asset cash up for the same amount. Now, the business activities that generate those revenues also create expenses. And under the accrual basis of accounting, expenses are recorded in the same period as the revenues to which they relate. This is what accountants call expense recognition principle, or the matching record expenses in the same period as the revenues with which they can be reasonably associated. And it is the timing of the underlying business activities, not the cash payments, that dictate when expenses are recognized. There's 3 possible cases here too, when the cash can be paid in comparison to when the expenses are recorded. Now, the first case, cash is paid before the expense is incurred. It is common for businesses to pay for something that provides benefits only in the future periods. For example, Sonic Gateway might buy some office supplies now, but not use them until next month. And under the expense recognition principle, the expense from using those supplies, or supplies expense, is reported next month, when the supplies are used to earn the revenue, not in the current month when the supplies were purchased. This month, supplies represent an asset, supplies. Similar situations arise when a company prepays rent or insurance this month and then uses up these assets in a later month. In the next case, case 2, the cash is paid when the expense is incurred. This is the best case scenario. Sonic Gateway has arranged to make automatic monthly payments to its utility company for electricity at the end of each month. And because the electricity is used up in the current month, it's an expense of the current month. So we can decrease our asset and increase our expense. In the last case, cash is paid after the expense is incurred. Most businesses acquire goods or services on credit. So it's common for them to incur the expense of using up the benefits of goods or services in the current month before paying for them in a later month. So back to our Sonic Gateway examples. If they placed an ad online but does not pay for their service until next month, then we would put this in case 3. Because the ads run in the current month, they are an expense that should be reported on this month's income statement. Because the cost has not yet been paid though, and will be paid later, the balance sheet reports a corresponding liability called accounts payable, and we talked about that last chapter.